In a challenging global economy, the strength of our capital markets is vital to long-term economic growth, yet regulatory burdens and bureaucracy are preventing small businesses from thriving and hindering in the United States' ability to compete globally. Small businesses, which are the fuel that powers our economic engine, make up 99% of all enterprises in the United States and employ almost half of our workforce. Prior to the COVID-19 pandemic, roughly 3/4 of all small businesses relied on financing in the last 12 months. Nearly 70% of startups received less financing than they initially requested, while 28% received no financing at all. The fact is, most people don't realize it, but 80% of business debt financing comes from investors in our capital markets, not from banks. The U.S. continues to experience a slump in the number of new businesses, which in 2016 hit a 40-year low. Last year showed a spark in IPOs that broke that disturbing trend. Until 2020, our economy launched half the number of domestic IPOs than it had 20 years ago. At the same time, the U.S. doubled the regulatory compliance cost of business incurs. Just one of the myriad reasons why the decline in traditional IPOs is the cost of going public. Costs associated with, quote, going public are high because investment bankers, lawyers, and auditors collectively charge millions of dollars to prepare the lengthy registration statement that is required to be filed with the SEC before any shares can be sold. Additionally, a series of regulatory burdens placed on public companies only adds even more costs to these companies. The SEC estimates the average cost of just achieving initial regulatory compliance for going public in a traditional IPO is $2.5 million, with an annual compliance cost averaging $1.5 million after that. These costs are prohibitive for small and other emerging companies focused on growing their businesses. As a result, more companies are opting for private fundraising over the costly hassle of entering our public markets. In 2016, private offerings in the U.S. raised nearly 5 times the equity as IPOs. In 1997, 8,884 companies were listed on exchanges in the U.S. Since then, the number of companies on the exchanges has decreased by more than half, which results in fewer investment choices for everyday Main Street mom-and-pop investors. In the U.S., there are 242 unicorns, startups with valuations of more than $1 billion that were privately financed as of November 2020. That's called a herd of unicorns. Those aren't unicorns. Conversely, as more businesses today remain privately funded instead of going public, the number of publicly held companies has declined to levels not seen since the 1980s. Decline in IPOs only hurt everyday American consumers, as I said, because there are fewer opportunities for them. It's important to note that while the U.S. IPO market has steadily decreased until last year, foreign markets, specifically China, are growing. China's annual GDP growth remains approximately 6.2% despite the recent trade war. Additionally, in 2020, mainland China was the only major economy to achieve positive economic growth. China's IPO market produced over 1/3 of the world's IPOs in 2020, reporting 536 out of the 1,363 IPOs across all global markets. Beijing's Made in China 2025 agenda lays out its plan to dominate the high-tech, biotech, and artificial intelligence industries within the next 10 years. Additionally, experts predict more IPO activity on mainland China's 14th five-year plan, which is designed to boost IPOs in specific sectors through direct financing. Increased pressure from foreign markets only heightens the necessity for immediate action and reform. Republicans support making our public markets more attractive. Make no mistake, China is aggressively pursuing policies that challenge us economically. This includes the IPO space. Republicans and Democrats must work together to continue to make our capital markets the envy of the world. Given the capital formation issues facing American companies, the decline in IPOs over the last several decades, this committee needs to be focused on legislative and regulatory frameworks that make our public markets more attractive and preserve various paths for companies to pursue going public. I look forward to hearing from our witnesses today, and I yield back.